Welcome to Market Brief After Hours. We have a lot of ground to cover today because the markets took a rather aggressive turn. We're looking at a landscape where fresh inflation data and a very cautious outlook from the Federal Reserve have essentially pushed equities deep into risk-off territory. Let's start with the big picture on Wall Street. The major indices really took a hit today, didn't they?
They absolutely did, and the selling pressure was relentless across the board. The Dow Jones Industrial Average was the major headline, dropping 768 points, or 1.63%. If we round to the nearest whole number, that puts the Dow at 46,225. What is highly significant here is that this marks a fresh 2026 low, and it actually broke right below its 200-day moving average. It is now down more than 5% for the month, which puts it on track for its weakest monthly performance since 2022.
That is a major technical breakdown. How did the S&P 500 and the Nasdaq fare in comparison?
The pain was definitely widespread. The S&P 500 extended its broad-based decline, falling 1.36% to close at 6,625. We saw selling pressure across multiple sectors as the market rapidly reassessed both inflation and monetary policy. Elevated input costs and rising energy prices are making investors very nervous about corporate profit margins in the coming months. As for the Nasdaq Composite, it slid 1.46%, closing at 22,152. Growth-oriented stocks were hit particularly hard by higher yields and inflation fears, which is a classic rotation away from risk assets when the rate environment becomes this uncertain.
You mentioned inflation fears and energy prices. It seems like the data we received today really caught the market off guard. Let's unpack those numbers.
The data was definitely hotter than anyone wanted to see. Producer prices rose 0.7% in February, which completely blew past the expectations of 0.3%. When you look at core PPI, it increased 0.5% month-on-month and accelerated to 3.9% year-on-year, the fastest pace we've seen in 3 years. On top of that, core PCE is estimated to have risen 0.4% on the month, keeping the annual rate stubbornly pinned at 3.1%. This tells us that underlying price pressures are not just persistent, they are deeply entrenched.
And that situation is only being exacerbated by what is happening in the energy markets right now. Geopolitical tensions are flaring up again.
Exactly. Escalating tensions in the Persian Gulf are raising serious fears of major supply disruptions. We are looking at a strike by Israel on Iran's largest gas processing facility, along with renewed threats against energy infrastructure in Saudi Arabia, the UAE, and Qatar. Because of this, oil prices surged sharply. Brent crude jumped 7.28% to $110.95 per barrel, and US crude settled at $99.56, which is an increase of 3.48%. Citi actually put out a warning today that disruptions could reach anywhere from 11 to 16 million barrels per day. If the strait remains closed, they see Brent potentially rising towards 120 in the near term and averaging as high as 130.
That kind of energy shock completely complicates the Federal Reserve's policy outlook. It's no wonder Treasury yields are moving higher. The 10-year yield climbed to 4.265%, and the 2-year yield rose to 3.775%. It seems the market is finally accepting that the Fed might have to maintain tighter policy for much longer. Let's shift our focus globally. How did European markets digest all of this?
Europe closed lower across the board as those same inflation and policy risks built up throughout their trading session. The Pan-European Stock 600 fell 0.7%. Looking at the individual countries, the UK's FTSE 100 dropped 0.9% to 10,305. In Germany, the DAX declined 0.91% to 23,515. And France's CAC 40 slipped 0.61% to 7,970. We also saw Italy's FTSE MIB fall 0.37% to 44,722, while Switzerland's SMI took a heavier hit, losing 1.52% to close at 12,765.48.
And did Europe have its own inflation data to contend with?
They did. Eurozone inflation was confirmed at 1.9% in February, but the real concern is beneath the surface. Core inflation rose to 2.4%, and services inflation accelerated to 3.4%. So even though energy costs had been easing previously, the underlying price pressures in Europe remain very sticky.
It's a very complex global picture. Before we dive into the Asian markets, the crypto sell-off, and the highly technical moves in the Forex space today, we are going to take a quick break.
Welcome back to Market Brief After Hours. Before the break, we covered the heavy losses in the US and Europe. Was there any bright spot in the Asian markets, or did they follow the global trend?
Asia was actually a bit of a mixed bag, which is interesting. Gains in the technology and automotive sectors managed to offset some of the geopolitical anxiety. In Japan, the Nikkei 225 closed completely flat at 53,700.39, while the broader Topics Index actually rose 0.45% to 3,627.07. South Korea had a great session, with the Kospi gaining 1.63% to 5,640.48. Hong Kong's Hang Seng edged up slightly by 0.13% to 25,868.54, though mainland China's CSI 300 declined 0.73% to 4,637.44. Elsewhere, Australia's ASX 200 rose 0.36% to 8,614.3, even after a rate hike to 4.1%. And in India, both the Sensex and Nifty 50 advanced 0.83%, heavily supported by regional tech momentum.
Speaking of momentum, or rather the lack thereof, the cryptocurrency market had a brutal session.
It was a massive risk-off shift. The crypto market lost more than $100 billion in total value today. Bitcoin fell about 5%, dropping below $71,000, which is a sharp reversal considering it was approaching $76,000 just yesterday. Major altcoins like Ethereum, Solana, and Dogecoin all declined between 5 and 6%. The GMCI 30 index dropped around 5%, pushing its year-to-date loss to 21%. And naturally, crypto-related equities felt the pain too. Galaxy Digital fell more than 8%, Strategy was down over 6%, and we saw declines of more than 3% in Coinbase, Riot Platforms, and MARA Holdings.
Let's transition over to the foreign exchange and commodities markets. The technical setups here are fascinating today, especially with the moving averages. Let's start with the euro against the dollar.
The euro continues to struggle. Euro USD closed at 1.1468, down a modest 0.06%, but it finished near the session low after trading as high as 1.1555. The technicals are heavily tilted to the downside here. The price is firmly below its key moving averages. The 50-day simple moving average is way up at 1.1733, the 100-day is at 1.1687, and the 200-day is at 1.1674. Immediate resistance is at 1.1555, but if this selling pressure continues, we could easily see the euro exposed to the 1.1400 level.
And the British pound seems to be in a similar boat?
Very much so. GBP USD slid further, closing at 1.3278, which is a drop of 0.59%. It also ended the session near its lows, signaling strong downside momentum. Just like the euro, the pound is trading below all its major averages. The 50-day SMA is at 1.3509, the 100-day is at 1.3396, and the 200-day is at 1.3438. This reinforces a very bearish short to medium-term outlook. If support at 1.3274 breaks, the door is wide open toward the 1.3200 level.
But the US dollar isn't strong against everything. Let's look at the Swiss franc and the Japanese yen.
Right, the safe haven dynamics are at play here. USD CHF posted a very strong bullish session, closing at 0.7928, up 1.12%. It has now moved above the 50-day SMA at 0.7802 and the 100-day SMA at 0.7897. It is currently testing immediate resistance at the 200-day SMA, which sits at 0.7953. A break above that would be a major bullish signal. As for the yen, USD JPY pushed higher toward the 160 level, closing at 159.83, up 0.53%. The uptrend here is incredibly well established. The price remains well above the 50-day SMA at 156.47, the 100 at 155.98, and the 200 at 151.87. All eyes are on that psychological 160.00 level right now.
What about precious metals? With inflation running hot, you might expect gold to rally, but that wasn't the case today.
Surprisingly, no. Gold actually broke lower, closing at $4,846, which is a sharp decline of 3.20%. It broke below its 50-day SMA at $4,961, which signals a real loss of short-term bullish momentum. However, the longer-term trend is still intact because the price remains above the 100-day at $4,574 and the 200-day at $4,055. If it falls further, $4,800 is the next support level to watch.
Silver followed a similar path, extending a sharp pullback to close at $75.99, down 4.15%. It moved below its 50-day SMA at 86.61, but again it remains above the 100-day at 72.13 and the 200-day at 56.31.
Let's wrap up with some of the individual market movers today. A few specific stocks made some massive moves on company-specific news.
We saw some dramatic price action in individual names. Gemini Space Station was a big loser, tumbling 16%. Citi downgraded the stock from neutral to sell, citing major concerns about the company's ability to scale profitability, especially in this weaker crypto environment. SailPoint also took a massive hit, dropping over 15% after they forecasted 2027 revenue between $1.26 billion and $1.27 billion, which missed analyst expectations of $1.28 billion.
And Rocket Lab had a tough day as well, correct?
Yes, Rocket Lab fell more than 11%. They announced plans to sell up to $1 billion in common stock, and the market immediately priced in that potential dilution. But it wasn't all bad news out there. Swarmer was the standout winner, surging an incredible 77%. There is a lot of speculation right now that increased US defense spending on low-cost drone systems could drive massive demand for their software solutions. Also, ZTO Express gained 7% after reporting better-than-expected revenue of 14.51 billion yuan and announcing a 1.5 billion share buyback program.
It truly is a market of individual stories right now, even amidst the broader macroeconomic headwinds. The speed at which sentiment shifted today really highlights how sensitive investors are to inflation risks and energy spikes. With the Fed signaling patience rather than flexibility, it seems the market remains highly exposed to further downside if the data continues to surprise. We will be watching those yields and energy markets very closely in the sessions ahead. If you find this useful, please follow Market Brief after hours.